Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your daily technical analysis of foreign exchange markets. I'll start with the euro against the dollar. An interesting pattern yesterday, a somewhat schizophrenic pattern as well. It was all of these three things at the same time. A bearish double, a bearish army, if only just, and a hanging man pattern. Now, you might say, hanging man pattern, why? Surely that is also a bearish pattern. Well, yes and no. Traditionally, the hanging man pattern is seen as bearish. However, data indicates that it performs as a bullish continuation pattern close to 6 out of 10 times. So it'll be interesting to see if the hanging man pattern performs traditionally or follows the data. Anyway, it was also a significant close back below the short medium moving average, currently 107.52, and the May 2020 low at 107.66. Indeed, prices ended up just above the April 2020 low at 107.25. Below, we now have the considerable and interesting support of the declining middle time, currently 106.81, of the well-highlighted January to May 2021 bearish Andrews pitchfork. Stepping back a bit, this close back below the short medium moving average after only a small single close over it is important. I would only ask you to look upwards on the daily chart the last time the market met the short medium moving average back at the end of March and the resultant move lower thereafter. It will now be interesting to see if the market makes its own way this time or repeats what happened back in late March. Meanwhile, the next overhead resistance is the February to date downtrend, currently at 107.92. Though this is only a 2-pointer, whilst further below the next support is the 2020 low at 106.35, but the better support starts from the April 2017 low at 105.68 and extends lower thereafter. So far today, a small but significant move lower below the April 2020 low, though still within yesterday's range. Cable, aka sterling against the US dollar. A reactionary bearish engulfing pattern yesterday after the previous 4 bullish white soldier sessions. It seems that the well-highlighted overhead resistances at 126.72 and the September 20 low at 126.86 have capped this market. However, the market is still within the free area between the congestion zone below, between 124.78 to 125.09, which contains the 38.2% Fibonacci line of the March 20, June 21 move at 124.89, and then these resistances at 126.72 and 126.86. We also have the high from 3 weeks ago in the 126.35 area in between, but I'm minded not to reference that too much right now. So far today, well, a small follow-on lower to yesterday's action, but it is currently limited as we are still within yesterday's range. Euro sterling. Yet further intraday indecision yesterday, but with a twist. It was an intraday, not an interday, an intraday indecisive doji cross, which was also an outside day. Now you can see why I'm going slightly nuts about this dichotomy, both directions indicated at once. All this after 3 previous sessions giving countering actions to the 3rd degree. Anyway, it still seems the market is not yet done with the pipe top stroke possible double top formed early last week. So that being said, just below current levels we have support from the following: the April 21 low at 84.70, the broken September 21 to date downtrend currently at 84.65. That makes up the upper trend line of the same diamond pattern, or the extended one. The flatlining long moving average currently 84.41. The upper trend line currently 84.07 of the smaller and more robust lopsided diamond pattern. And finally moving up and into the frame the short medium moving average currently 84.19. For the moment we still have on the upside for the smaller lopsided diamond pattern a primary target X in the 86.80 area and a harder to get secondary target X1 in the 87.65 area. And for the extended diamond pattern we have a primary target X2 in the 87.15 area and a harder to get secondary target X3 in the 88 even area. Additionally, there is also one final pattern, and it is the big one, which this market has previously triggered but then also sent mixed messages on. I've spoken for weeks now, months even, of the very large falling wedge pattern, currently 84.65 to 81.54. This pattern is still in operation, but has fallen into shadows a little with the rising prominence of the diamond patterns. And though triggered, the pattern still leaves us with some questions. You see, it has the most ambitious upside target of all. Target X5 for this pattern is in the 88.65 area, and that is a really big ask. So far today, again, nothing much. A dip lower, but a recovery and a move higher that stopped ahead of yesterday's high. All this is contained within yesterday's range, and today is looking right now like an indecisive pattern, possibly an indecisive spinning top right now. US dollar against the Indian rupee. Another interesting pattern yesterday. This time an inverted hammer pattern. Immediately following, I was about to say normal, but nothing is normal in this market. Let's call it a regular hammer pattern. The market opened below the May-based uptrend, currently at 77.58, but ended up closing just over it. Now, inverted hammer patterns are traditionally seen as a bullish reversal pattern. However, data indicates that between 6 to 7 times out of 10, they act as bearish continuation patterns. So it'll be interesting to see if the market follows tradition or the data. Overall, the market is still within the new congestion zone between 77.40 to 77.80. However, as stated yesterday, there seems to be a possible new element in the mix. You see, whilst in the big picture, the market's overall still in between the lower time below, currently 77.31, and the middle time above, currently 78.77 of the mid-January to early April bullish Andrews pitchfork. Plus we have overhead target X in the 78.30 area. This is the potential target for the whole of the 22 action, being a possible bullish halfway hesitation. You see, with all these big picture patterns, we should not overlook something growing at our feet. And by that I mean that the last 3 weeks action do have elements of a horn top as well as elements of a possible ascending triangle pattern. These are not fully developed patterns as yet, just actions that have elements of these patterns. Hence I'll ponder on these a little more as the market continues to seemingly still be trying to make up its mind about what's next. Now, so far today, a higher open, but then a seemingly strong move down through the uptrend, currently 77.58 of the new possible ascending triangle pattern, and sort of matching the low for this week. And looking right now like a possible bearish engulfing pattern, and first close below that uptrend line. US dollar against the Brazilian real. An immediate countering bearish double yesterday, in response to the previous session's hammer pattern. To me, this action is more about the countering than the bearishness. You see, as the recent fall in the market had seen the move down be eroded by congestion under the overhead short medium moving average, currently 484.39, from levels at 484.26, which is the 50% Fibonacci line of the June 19 to May 20 move, plus the June 20 low at 81.62, as well as 477.54, which is the 50% Fibonacci of the October 18 to May 20 move. All these are now resistances. And the 50% Fibonacci line at 477.54 did cap the market yesterday. However, below we have the heavily marked congestion at 472.90 to 472.92. And though prices dipped below there, as well as the next support of 471.42, the market has still failed to consolidate the move lower, despite yesterday's overtly bearish action, at least not yet. You see, this doesn't mean that the move lower is over, but it does show a rest period for this market. Overall, we are still in between the upper time, currently 505.58, and the middle time, currently 459.48, of the start of 2022 to date bearish Andrews pitchfork. This is still an early development bearish pitchfork, but it is starting to show some merit in forming and hence showing the recent bearish angle of attack. It will be interesting to see what happens if and when the market approaches the middle time below. US dollar against the Mexican peso. A bullish white soldier yesterday after the previous session's significant hammer pattern. Now usually seen as a bullish pattern, which had seen the long tail reach down and properly fulfill target X in the 1954 area. That was for the late April to early May cat's ears pattern. Then that dropped below the 21 low at 1953.63, as well as the middle time, currently 1949.96 in November 21 to March 22 bearish Andrews pitchfork. It was at that point, on that day, that I suspect the market realized that though it was bearish, it was not that bearish, and thus closed back up over the middle time. Yesterday took this higher up to the next resistance at 1971.68, and that's the April 22 low, piercing it, but still closing below it. It was the second day now that I was left wondering if the market really wants to move lower, other than to maybe travel lower along the middle time. You see, there is also another pattern in possible construction. Yesterday could be day 3 in a 3-day bullish morning star pattern, which would be an elegant solution to any pullback up in this otherwise bearish market. So far today, a slightly lower opening and a move up to test the April 22 low at 1971.68, though so far not breaching it. Thank you for listening. This short version broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investors International Limited. And here comes the final bit.